Good evening, everybody. I feel like I should start with, and now for something completely different. No, I mean, tonight's all about feel-good investing, and you couldn't have a night of feel-good investing without talking about UK equities. I know that's what you've been waiting for. So I'm going to talk about two things tonight. One is the UK equities opportunity, and you may have heard that before in the last few years, but I really think it's a fascinating area to discuss. And the second one is the Merchants Trust, which obviously I'm the manager of, and delighted to be here and talk about that. And that bit, I might rush a bit, but there's a lot on the website. Some of you have heard me before, so let's see how we go. UK equities opportunity. So this is a very complicated slide, I'm afraid, but what it's showing you is that, as you probably know, the UK market's been massively out of favour for a long period of time, and there's been huge selling. So here, on the left-hand side, you've got who owns the UK stock market. And back in the 1990s, you had this red and pink group of investors, which are UK institutions, UK pension funds. They owned half the stock market when I started my career. And they have gradually been selling down for the last 35, 40 years. They now own 4.5%. They've pretty much sold everything they can from domestic equities. I see this as a glass half full, not half empty. They can't sell much more, right? The market now, and the private investors, some such as yourselves perhaps, that's the grey bar at the top, still own 10, 12%, but it used to be, even before the institutions, they owned half the market back in the 1960s. So private investors don't own very much. The biggest block is the blue blob, which is overseas foreign investors. And so what that means really is that foreign investors will only buy the UK if they think the UK is interesting or attractive, or if there's some really interesting companies in the UK they want to own. Now, from the base that we're at, which is very, very depressed sentiment, this, I think, can only go one way, i.e. if there's any sign that the UK is more interesting, a lot more money can come into the UK, and actually the domestic investors who generally have gone to technology, to global, elsewhere, they might start to say, actually, it's quite interested, and there's not many people left to sell it. The other chart on the right-hand side is a sentiment indicator of fund managers. Where do you want to be invested, or where are you invested? And the UK is the most unpopular area, which is always an interesting place to look as an investor. The UK is the most unpopular. Actually, this survey has a great record of being a good contra indicator. So not saying it will be, but UK is out of favour. So, you know, why is the UK interesting? I think there's been this narrative about the UK that the economy is terrible, that the UK is the sick man of Europe. The Bank of England in November 2022 was saying the UK is expected to fall into the longest ever recession, according to the BBC. And what happened? Well, you saw it earlier from Paul. Actually, UK economic growth was revised up significantly last year, and we ended up with an okay year in the economy. Not great, certainly, but no worse than elsewhere. If you look, and Paul again set this up very nicely, purchasing management indices, views of from companies on the ground, what's going to happen. Actually, the UK, things have deteriorated a little bit, but actually UK surveys are stronger than actually most other countries. So things aren't that bad. I mean, they're not great, but they're no worse than elsewhere. And this is a common theme. The UK economy, since 2016, since the time of, a lot of these charts start in 2016, the time of the Brexit referendum, the UK economy did very badly during the COVID pandemic, but it's recovered, and now it looks like the same, pretty much the average of the G7 large economies. So the UK hasn't been great, but it's actually been no worse than elsewhere as an economy. Don't forget, of course, UK equities, about 70% of sales and profits of UK equities come from abroad, come from elsewhere. So the domestic economy is not the most important thing for many UK companies. But a lot of people don't like the UK because they think the UK economy has a problem. Real earnings growth. People talk about real earnings growth going nowhere for a decade. That's sort of true, but it's sort of not true. Actually, since about 2013, 2014, real earnings growth has been quite positive and growing quite fast. And at the moment, inflation's falling away, earnings growth staying quite high. This trend is probably continuing. So things aren't that bad. Again, Paul covered this earlier. Inflation has come down dramatically. There was perceived to be an inflation problem in the UK. Things were perceived to be a lot worse than elsewhere. Actually, it looks very similar now to elsewhere. Maybe a little bit higher still, but coming down rapidly, as Paul said earlier. And interest rate expectations, again, you've covered this as well earlier. Slightly different chart. If you go back to June last year, investors were expecting, or people were expecting interest rates to go up further to over 6%. Now they're expected to come down, this is a bit out of date, to about 4.3% or something like that in 6 months' time. But they're expected to be cut rather than going up. And that's quite important for the economic outlook. Valuations, and valuations do matter, and I'll come back to that in a minute, but the valuation of the UK, as I think most of you probably know, is quite depressed. It's pretty much, this is a chart from Goldman Sachs on the left, the UK is pretty much as cheap as it's been in the last 20 years. It's down at 10.7 times earnings in a long-term range of between 10 and 16 or so. At the same time, the US is pretty much as expensive or as highly rated, maybe not expensive, as highly rated as it has been in the last 20 years. That's quite an unusual combination to have the UK looking cheap and the US looking at the top of its previous range. So that makes me think what's going on. And within the UK market, you've got this enormous spread, dispersion of valuations. This chart from Morgan Stanley looks at the valuation of growth companies compared to value companies. What it's essentially saying, as the chart goes down, the value companies are looking cheaper compared to growth companies than they were previously, or the spread of valuations in the market is wide. As a stock picker, these charts are great. The market's lowly priced. There's a great dispersion. That means there must be lots of opportunities out there, lots of great stocks that potentially you can buy at attractive prices. So really interesting. Now, the UK market has derated since, come back to 2016. The chart on the left goes back a long way, goes back to 1975. But what you'll see is since 2016, the UK has steadily got cheaper and cheaper and cheaper compared to the rest of the world. And the reasons for that, we all know. The Brexit referendum, people got worried about that. We had a period of political uncertainty with Jeremy Corbyn and Boris Johnson fighting it out. We had the pandemic, which hit the UK pretty hard initially. The Ukraine invasion affected the whole of Europe, actually, in terms of inflationary costs, much more than it did elsewhere. All of these reasons were reasons to avoid the UK. All of them are in the past. There was this idea, as I talked about, that the UK had an inflation or a growth problem. I think, again, that's in the past now. And there was, let's not forget, Liz Truss quasi-Kwarteng mini-budget as well, just to add some icing to the cake. So there's been lots of reasons. Politics today in the UK looks relatively boring, maybe not to people who are really interested in politics, but from a market point of view, the policy gap between Labour and Conservatives is not that great. And the one thing they have learned from quasi-Kwarteng being Chancellor is that markets will tell you what you can do as a politician, more so than ever before. So actually, the political risk from a market point of view in the UK looks pretty modest. And when you compare it to what's going on in America or what's going on in parts of Europe, actually, I'd say the UK looks pretty stable and pretty secure from an investment point of view in terms of political risk. So a lot of these things were in the past. So who is buying the UK market? If people are selling it, who's buying it? Well, the companies are buying it. And you can see on this chart, on the right-hand side, so it's a complicated chart. It shows buying of equity by companies, sort of issuing of equity in dark green, when companies issue equity and raise capital, and buying back in light green. And the purplish colour is the net buybacks of company stock. And you'll see in the UK there's been enormous net buybacks of equity by companies. You know, Barclays Bank yesterday announced 10 billion of capital returns in the next 3 years, of which the majority is coming in buybacks. Companies see that their equity is cheap. Nobody else wants to buy it. They're buying it back. On top of that, you're seeing corporates come in. We had a takeover bid for Currys earlier this week. Lots of takeovers in the UK. So far, they've not moved the market price. But if other people stop selling, that price will move. So lots of buyers coming in, or companies buying back their stock. All the reasons why you didn't want to own the market previously, potentially falling away. So really interesting time. And come back to why valuation matters. This chart, fascinating, from Liberum Research, came out in January. They've gone back till the end of the Second World War, and they said, let's look at what happens if you bought the market at different valuations. So each of those blobs is a period in time when you could have bought the market, and it shows you what happened. It shows you the valuation of the market along the bottom line, the x-axis, and the current valuation of the market is a price-earnings ratio of 10. You're paying £10 for every pound of profit. And the y-axis, the vertical line, how return you would have got over the subsequent 10 years if you'd bought the market at that level. And what you can see very clearly is the dots generally go from high to low, left to right. If you paid low prices for the market, on average, you did a lot better than if you paid high prices. And all the best periods of market returns have come when the market was very low price. This is a 10-year return, right? It comes back to something Ryan was saying earlier. You've got to be patient. It doesn't happen year after year. It's not saying anything about the next 6 months. But on average, if you have historically bought the market at a low price, you've done better than if buying at a high price. And if you bought the market at today's level or lower at any point since the Second World War and held it for 10 years, the worst return you've made is more than 5% per annum. And the average return you've made is 13% return per annum. There's lots of reasons why you might not like the UK, but if the worst return you're likely to get, historically at least, is 5% per annum, that's not a bad place to be. Okay, you can get that in cash, maybe today-ish, but you could do better than that, and cash returns probably come down. But anyway, this is an interesting, valuation does matter, and this is quite an interesting chart. Now, I'm probably running out of time already. So, second topic is the Merchants Trust. What do we do in Merchants Trust? We are invested predominantly in UK equities. 95% of the portfolio is in UK equities, and we're trying to deliver a high and rising income stream and a good total return. We have a dividend yield of 5.3%. We've grown that dividend every year for 41 years, so we're a dividend hero. We've got a strong record. I mean, Ryan explained it earlier. High conviction, active stock selection. That's why the record moves around. That's why we have good years and bad years. But we are definitely taking some strong views. And we have a low management fee. The ongoing charge is about 0.58% overall, and a very experienced board of directors. That's just the objectives of the trust and some data. 14% gearing, about 900 million of assets. Simple philosophy. What we're trying to do, we're trying to buy companies that are materially undervalued. In order to do that, we actually tend to be quite contrarian. You don't have to be, but if you want to buy a good company that's cheap, it tends to happen when they're out of favour for a reason. And we do it fairly concentrated, fairly high conviction portfolio. But you also need to think about risk. We think about risk at the company level. We think about risk at the overall portfolio level. I've got 5 minutes left. So it's not just about individual stock risk. It's about how much exposure do you have to international stocks, domestic stocks, cyclicals, defences, all of that stuff. We look for 3 things in a company. We look for strong fundamentals. We look for attractive valuation, and you can see some of the things we look for in each of those. But also we look for what's going to change. We look for the longer term themes, what's driving that company. And if you can get all 3 of those together, that can be quite powerful. I'll give you an example. It's easier to explain with an example. Assura Healthcare, they own about 612, I think it is, health facilities, mostly GP surgeries, and mostly in the UK. They've got about 10% of the market. It's a strong business. Their tenant, although it's GP, effectively the rent is paid by the NHS in most cases. Very strong tenant quality. They're a joint market leader with about 10% market share. They've got very low cost long-term funding, a 2.3% cost of debt. The problem at the moment is that developments are a bit constrained because they're not getting the government's not really paying them the rents they need to fund a new development because inflation costs have gone up. And it's quite hard to fund new developments. But it's a strong portfolio. You've got an ageing population, so long-term the demand for healthcare is incredibly strong. There's not that much supply of these properties. There's inflation linkage to some extent. It's quite complicated, but there is some inflation linkage in the properties. There is a negative. There is a cost to make these properties more environmentally friendly, but that's a manageable cost. And they would be a beneficiary if interest rates come down. So strong business, attractive long-term themes, and valuation now. When we bought it, this is actually back in a few months ago, dividend yield about 7%, discount to asset value. Those assets are quite depressed because as bond yields went up, the valuation went down. So we felt that was quite an interesting stock. Not the most exciting stock, right? But very solid, nice dividend yield, very strong property portfolio. Putting all that together, if you look at our portfolio overall, this chart breaks down the valuation of our portfolio by PE. you'll see most of our portfolios on the left-hand side in relatively low PE companies, very lowly priced companies. The overall market in light blue is much more polarised. You've got quite a lot of cheap companies in the UK, or lowly priced, and quite a lot of very high-priced companies. We don't think you need to go into, in our portfolio, we don't go into the higher price ones. Some of them are great businesses, but we think there's a lot of attractive companies at the cheap end. So we're very different. That's just a list of the activity. We are active investors. We bought 7 new companies in the last year, mostly in the mid-cap area. That's where we've been finding the best value in the last year. And we've sold about 9 companies last year. There are 1 or 2 international companies in there, if you're sharp-eyed. But where we can find interesting opportunities overseas, we're happy to do that as well. But it's about 95% UK portfolio. Some of the companies, some of the themes, I mean, we absolutely believe in the digital economy, but there's ways of playing that at a very sensible valuation, companies that have got enormous potential to benefit from that. I think there's also things, let's not forget, there are physical things in the world. We're all here today, right? Being back in person is great. There are lots of things that don't happen in the virtual world, but actually, to deliver the energy transition, to deliver the virtual world, you need a lot of copper as well. You need copper miners like Atalaya, like Rio Tinto. You need companies that can distribute electricity, and we need a huge amount of electricity around the network. So there are themes within the portfolio that we have exposure to, but at valuations that we think are really quite interesting. Just a couple of points on the trust. The trust has grown the dividend every year for 41 years. In good years, the directors can put money away into reserves. One of the fantastic things about investment trusts, as I don't need to tell most of the audience, is that you can put money away into reserves in good years to keep growing the dividend in difficult years. We've done that very effectively. The dividend last financial year, January 2023, was covered by earnings, and we've continued to see a decent earnings trend in the last financial year. I can't actually give you the numbers now because they haven't yet been published, but at the interim stage, we were certainly looking at good trends in terms of income in the market. And the performance record, again, Ryan covered this earlier, but we've delivered, with some volatility, we've delivered very strong numbers, both at the overall NAV level, at the share price level. Those are the bluish lines compared to the benchmark. And if you break it down at the portfolio level as well, over 10 years, we've delivered about 1% outperformance per annum. Over 5 years, it's a bit more than that, about 2%. And this strips out the gearing effect, so it's not about the gearing. So just to summarise, Merchants Trust has a 5% yield, has a very high conviction, value-driven approach. We actually think the UK is a really interesting place to look at the moment. I would say that, wouldn't I? But I've been saying it for a while. But a lot of the reasons that have been reasons why people have avoided the UK in the last few years, I think, are now in the rearview mirror. And I think it's I think it'd be interesting to see how it develops in the next months and years ahead. We've got a really strong track record with experienced board of directors as well. And with that, I'm glad to say thank you for your attention tonight.